I will encourage us to be persistent, not to give up, not to relent. Failure is part of the success story. It's always part of the success story. So I will encourage us to go again this diet, and I pray God will give us the grace to finish strong. Okay, so quickly let's just pray to just commit this diet into God's hands. Father, in Jesus' name, Lord, we thank you for this section. We pray that as we start this section, you give us wisdom, give us guidance, give us direction. We pray that you supply all the necessary strength, the necessary resources that are needed for this section in the name of Jesus. And we pray that at the end of this section, we are focused to glorify you, and we shall testify and we shall make good success in the name of Jesus. Thank you, Father, for in Jesus' name we pray. Amen.
Amen.
Amen. All right.
Amen.
So quickly.
Amen.
So quickly, group accounts. Group account at this level is not alien to us all. We are all familiar with.
Amen. Thank you.
With that, we're familiar with group account at this level. So, and when we say group account, we know that group accounts is the accounts of the parent company plus its subsidiary, prepared and presented as if they are what? They're a single economic entity. What that simply means is that when you consolidate the accounts of a parent company, that is the one that acquired control over another entity, and you consolidate its account with that of the subsidiary, the end result is a what? Is a group account. Is a group account. And we are all aware that there are various standards that in one aspect of the other, they affect our what? The preparation of what? Of group accounts. The first one, we have IAS 27, which is our separate financial statements. IAS 28, investments in associate and joint investments and joint ventures. IFRS 3, business combination. IFRS 10, consolidated financial statement itself. IFRS 11, IFRS 12, IFRS 13. So all these standards, they guide us in the preparation of what? Of our group accounts as a whole. So we all know that the parent company is a company that acquires control in what? In another entity. They acquire control in another entity. So we regard to them as what? The parent company. So in simple terms, a parent company is simply an investor. An investor that wants to invest in what? In an entity. So if an investment should purchase more than what? 50% of the what? Of the equity share of another company, that investor is seen to be the what? The parent company, because the acquisition of more than 50%, right, gives the investor what is known as what? Control. So that is, the investor has control over that entity. And in line with IFRS 3 and IFRS 10, such relationship or such control will lead to what? Full consolidation. Full consolidation. And in this case, the other entity that is being acquired by the parent company is known as what? As a subsidiary. So in this case, the subsidiary is another entity that is being owned and controlled by the what? By the parent company. By the parent company. So in this case, whenever they acquire more than 50%, such investment gives birth to what? To parent and subsidiary relationship. And whenever this is the case, IFRS 3 and IFRS 10 asks us to do what is known as what? Full consolidation. What that means is that the assets, the liabilities, the income, and the expense of the what? Of the subsidiary will be consolidated with that of the what? With that of the parent company. So if we have the parent company, we have the subsidiary, the assets of the parent company will be added to the asset of the subsidiary in full, and this will give us what? Full consolidation. So we are aware of this. Then also we are also aware that whenever an investor, which can also be seen as the parent company, whenever they acquire 20% and above, but below what? 50%. But below 50%, then in that case, this kind of investment will give birth to what is known as what? Significant influence. Significant influence. So whenever they purchase more than 20% of the equity share of or the rights of another entity, but below 50%, then in that case we have what is known as what? Significant influence. And when there's significant influence, the other entity that is being acquired, that they acquired their equity share, will be seen to be the what? The associate. Will be seen as an associate of the what? Of the parent company. So in this case, this entity is not regarded as a what? As a subsidiary, but rather as an associate. Then in this case, IAS 28 applies, which is known as what? Investment in associates and what? And joint ventures. So we followed what? The accounting guidelines prescribed by the standard IAS 28. And here we don't do full consolidation. Rather, we make use of what? Of the equity method of accounting to account for the what? For that investment that we have in associate. So meaning that the investments in the associate will be accounted initially at what? At cost. Then subsequently adjusted for what? For any post-acquisition profits that may accrue in the course of the what? Of the business. I hope we are getting it. And I'm sure we all understand this as we have done it in prior section. Also,
take it again, sir. Take it again.
Which part?
Sorry, can you please take the
associate
again?
IAS 28 equity method.
Okay. So now,
excuse me, please, can you take it again?
yes,
Let's start from
that's what I'm about.
I think a bit fast. Thank you.
Oh, okay. Let me take it a little bit slower now. So now, if a parent company or an investor decide to invest in another entity, and they do that by acquiring 20%, it can be 20%, it can be more than 20%, it can be 40, 30, 35, depending. So, but below 50%. So anything starting from 20% and above, but below 50%. We give this parent company or investor ownership in that what? In that company. Of course, you have ownership in that company. But however, this form of ownership does not give back to what? To control. Does not give back to control. It gives back to what? To significant influence. To significant influence. I think someone's mic is not muted. Please check and mute your mic. So it will give back to what? Significant influence. And when we say significant influence, they have the rights, but not the power to participate in the what? In the operating decision of that company, in the financing decision of that company, and in the investing decision of that company. But they don't have control over those what? Over those decisions. Which means that they can bring suggestions, they can bring contributions, but those suggestions and contributions is subject to what? To approval by those that has control. Because obviously, if you don't have control, there's someone else that definitely must have what? Must have control. So if you acquire 20% and below, someone else acquire, if you acquire 20%, assuming 20% direct specifically, then someone else is acquiring what? The 80%. Because a company as a whole should be what? Should be 100%. It's assumed to be 100%. So if an investor is acquiring 20%, then someone else is owns the what? 80%. So now this gives back to significant influence. That entity that they acquired to the investor, that entity is what? Is known as what? Associate. For instance, A acquired 30% of the equity share of B Limited. A can be seen to be the what? The parent company. But in this case, B is what? Is an associate of that parent company. Now, these investments that they have in these associates, you must account for it in your book of accounts, right? So how do you account for it? You account for it by following the what? The accounting guidelines or accounting procedures prescribed by the standard IAS 28, investment in associates and joint venture. Now, in line with IAS 28, how do we account for our investments in associates or joint ventures? IAS 28 says that upon acquisition, Chiamaka, you have a question? Okay.
Hello, can you hear me?
I can hear you.
I want to just clarify something. So
Alright.
if the PC owns more than 50%, so
Yes.
that means it's subsidiary, right?
Exactly.
And then
Exactly.
if they own exactly 50%, so that is joint venture.
Exactly. Joint
And then less than
control.
50%, right?
Yeah, we call it
How
joint
do you say?
arrangement. We call it joint arrangement.
Joint arrangement. Okay,
Yes.
and then from 20% to
49.
49% is significant
Associates.
influence.
Yes, which means that those entities and associates.
Okay, the significant influence is associates. Okay.
Yes. Control is a subsidiary. Once you have control, then that party in which you have control over is your subsidiary. But if you have significant influence, so that party that you have significant influence over, they are your what? They are your associates. Do you get, Chiamaka?
Yes, thank you.
You're welcome. Sorry, I don't know your name. Please, your name is not showing. Your answer, or please, you can speak, sir.
Okay, so I wanted to ask, what if like nobody buys above 50% of the equity shares of a company? Like who will not be in control of that company?
The substance, there will definitely be substance over form. In that case, you follow the procedures in line with IS1. The substance, you look at the substance rather than the words, than the mere legal form of that transaction. And in reality now, I don't think something like that does exist. There must be someone that has control, either directly or indirectly. There must be someone that has control, that you must know that this person is one that is what has the final say. In all business organization, you must definitely see someone that has that. So is that clear?
Okay.
I'm with you, please.
Sorry, sir. Please, for 0 to 19% is what?
I'm still coming to that part. We'll get there.
Okay.
Yeah. Aminat, you have a question for me?
Yes, that's the question I wanted to ask. You said you would get it.
Okay, that's your question.
Yes.
All right. Okay, so now, Solomon.
Good morning, all.
Yeah, good morning, sir.
Please, sir, sorry, thank you so much, but I want just to get a clarification of, you made mention of associate. We are not using a full accounting method or something like that. You mentioned equity, cost, and post-acquisition. I think that's where my confusions are. Thank you.
Okay, that's what I'm about to explain, sir.
Okay, sir.
So now, in line with IS 28, how do we account for our investment in associates? The standard says that upon acquisition, immediately you acquire that percentage holding in that company, that you should account for that investment at cost. At cost. What does that mean? It means for you to acquire percentage holding, you must have transferred economic resources, which can either be in form of cash or transfer or any other form. So let's assume in this case now, cash, you paid cash, you transfer cash. What do? You credit your cash. Cash has gone out. What do? You debit your assets, your non-current assets, investments in associates. So let me make it more, let's clarify it further. Let's attach a figure. Let's say 20 billion, 20 billion. So in your financial statements, you should be having this transaction should be reflecting, should be having a assets, a non-current assets, a line item, which title is what? Investment in associates. Then your cash would have reduced because you paid in cash to acquire this. So doing this, you are accounting for the investment at cost. Then subsequently, because this associate they'll continue in business, right? They'll continue doing business. So let's say this is day one. And let's say this is the beginning of the year. Let's now assume at the 365 at the end of the year now. That is subsequently. Please, I believe we are all aware that when we are doing financial reporting is usually done every year, at the end of every year. So it's usually for a year. But sometimes an entity can report for a month, 2 months, 6 months as required. So subsequently, they need to adjust. The standard says they need to now what? Be concerned about what? Post acquisition profits of the what? Of their investment in that associate. How do we do this? So it means that our post acquisition profit now, will be adjusted for in our investment in associates. So in day 36, our investment in associates would be adjusted for. So here we have the cost of acquisition, the amount we actually purchase it, 20 billion for the illustration we are looking at. Then you now add the parent company share of post acquisition profit. So it can be loss as well. If it's a loss, you subtract it. If it's a profit, you add. So it means that if the associates has done business from January to December, and at December they recorded a profit, that parent company what we share out of that profit, that is what that is recorded by the associate. That's what it means. So, and in simple terms, to get post acquisition profit, it is simply the retained earnings at date of consolidation minus retained earnings at date of acquisition. So, and we all know that retained earnings represent profit or accumulated profit. So this is this. Then there are some other adjustments too that we need to make. If there is impairment, that is, if the associate is being impaired, that amount of impairment should be subtracted from that investment in associates. And it should be noted that impairment should be subtracted in full. Impairment should be subtracted in full. So we don't do parent company share. So parent company percentage, unlike that of the profit. That of the profit, you only apply the percentage that the parent company has. But in impairment, they'll give you the full amount, and it's the full amount you are to subtract. You don't prorate. Then also, when there is we call it unrealized profits on inventory. So whenever there is sales between the parent company and the associates, because the parent company is seen to be an entity, while the associates is also seen to be a separate entity on its own as well. So each individually conducting business separately. So the two of them can also have form of business transactions whereby they sell maybe they have what they need in common in form of inventory. So in that case, when there is unrealized profit on inventory, we need to make adjustment for it. So we subtract the parent company share of the what? Unrealized profits. Our balance is what we are recognizing on our financial statement as at day 36. Do we get it now? So this is the amount that we are to recognize. It will no longer be 20 billion. This would have happened. The company would have either made a profit or loss. They would have either been impaired. If yes, if they're impaired, it's okay. If they are not impaired, the year will be zero. Then if there is transaction between them that has to do with inventory, then any unrealized profits on that inventory should be what? Should be adjusted for accordingly. Then this balance is what we are now recognizing at day 36, which is the reporting period. Is this clear now?
Yes, sir, please, can you explain what will be the parent percentage on the unrealized profit on inventory? Can you just throw more light on it?
Okay, this parent company percentage, right? Hello, do you mean this
Yes.
parent company? Okay, so it's just
Yes.
this percentage that they acquire here, this 30%. So that's the percentage that they acquire that gives them significant influence, or that made that other entity to become their associates. Is that percentage that we are talking about here. So for this illustration, the percentage is what? Is 30%. So you apply this 30% on the value of the what? Unrealized profit on inventory. When you apply it, the resulting figure is what we are bringing here. Let's assume that unrealized profit on inventory is 5 billion. So parent company share of unrealized profit will be what? 5 billion multiplied by what? 30%. Right? And that will give us maybe 2 point something. No, is it up to 2 points?
1 point.
1 point.
Right.
So did you get it now?
Yeah. Thank you, sir. Yeah.
You're welcome. So I think that is clear enough.
Hello, sir.
All right, sir. I'm with you.
Sorry, these notes, are you sending it to us?
Oh, yes, sir. You will definitely get it, sir.
Okay, thank you.
You're welcome, sir. So that's the second form of investment. The third form of investment is when a parent company or an investor, when they acquire from 1% to 19%. From 1% to 19%. This kind of investment is known as what? As simple investment. This simple investment does not give the parent company control, neither does it give the parent company significant influence over the other entity. Also, it is also known as minor investment. And sometimes also referred to as what? Ordinary investment. Now, this conform investment does not give control, neither does it guarantee significant influence. If we have this kind of investment, how do we now account for this kind of investment? The standard says that this kind of investment should be accounted for in line with what? With the prescription of IFRS 9, financial instruments. And this kind of investment will be accounted for at what? At fair value. Either at fair value through profit or loss, or at fair value through other comprehensive income. So this investment should be accounted for awards at fair value. Are we clear on that? So those are the various investments that we can put in what? In our group account. So when we have control, do full consolidation. When we have significant influence, we don't do full consolidation. Rather, we only account for the post-acquisition reserve of our investments in the associates. Then, when we have simple investments, we just account for them as financial instruments, as our normal investments, accounting for it at what? At fair value. At fair value. So, back to the parent company relationship, parent company and subsidiary relationship that we are more concerned about. So IFRS 9 is specifically addressed in another section. So you know that we have types of subsidiary. We have 5 types of them. We have fully owned subsidiary. We have partly owned subsidiary. We have we have subsidiary, and we have foreign subsidiary. So we all know that when we are talking about a fully owned subsidiary is a subsidiary that is fully owned by the what? By the parent company. What does that mean? It means that the parent company acquires the entire equity share of that what? Of that subsidiary company. Meaning that they acquire 100% of the what? Of the rights, equity right of that company. And in this case, there is no existence of the people who know that is referred to as what? NCI. There is no existence of non-controlling interest shareholders. So it's only the parent company that what? That has full control, full ownership. But in the other hand, where we have partner subsidiary, it is a form of subsidiary that the parent company acquires more than 50%, but below what? 100% of the equity share of that subsidiary. Meaning that there is what? There is the existence of NCI. So the non-controlling interest, they also have interest in the company, but their interest does not give them what? Control. Does not give them control. Also, we have fellow subsidiary. Now, when we say fellow subsidiaries are various subsidiaries that are being owned and controlled by the same parent company. Let's give a simple illustration. Let's say let me do that here. Fellow subsidiary. So let's assume that Dangote Group. Please, who can give us the subsidiaries of Dangote Group? We have Dangote Cement.
Plumbing.
We have Dangote
Flour.
Dangote sugar and salt.
Sugar. We have
Salt.
Dangote Salt. So let's stop here. So Dangote Group is a parent company. This is a subsidiary. Of Dangote Group. This is also a what? Subsidiary. Now, Dangote Cement and Dangote Sugar and Dangote Salt together, they are seen as what? They are regarded as what? Fellow subsidiaries. Fellow subsidiaries, because they are owned and controlled by the same parent company. That's a fellow subsidiary. But on the other hand, where we have the sub-subsidiary, a sub-subsidiary is a subsidiary that is parent company is a subsidiary to what? To another company. What do we mean? Or how do I mean? So subsidiary. Let's take Dangote Group as a case study as well. Dangote Group. So Dangote Group acquires Dangote. I think we have Dangote Oil and Gas now, if I'm not mistaken. So Dangote Oil and Gas is a subsidiary. This is a parent company. This is a subsidiary. Let's start say Dangote Oil and Gas. This is an illustration now. Now acquires, okay, let me even put the percentage holding to make it more interesting. Let's say 80%. Then this guy now acquires 60% of, let me see, think of another company now. Let me just choose a random company. Please, can someone just suggest? You say what?
MRS.
X, like this, right? So, Dangote and Gas purchases MRX, right? This MRX is also a what? A subsidiary of who? Of Dangote Oil and Gas. Dangote Oil and Gas is a parent company to what? To MRS. The parent company to MRS. MRS is subsidiary of what? Dangote Oil and Gas. But to Dangote Group PLC as a whole now, who is MRS? Now, because Dangote PLC has control over Dangote Oil and Gas, and also Dangote Oil and Gas has control over MRS. Therefore, MRS to Dangote PLC is a what? Is a subsidiary. That's why we said a subsidiary is a subsidiary that its parent company is also a subsidiary to another what? To another company. So I'm sure we get this part. So then lastly, we have our foreign subsidiary. So the foreign subsidiary is a subsidiary whereby the parent company is in a geographical location that is different from the what? From the subsidiary company. So if we have A Limited that acquires 80% or that acquires control of B PLC, So if obviously this is a parent company and this is the what? Subsidiary of the parent company. If this guy is in Nigeria and this guy is in the UK, so obviously this guy is a what? Is a foreign subsidiary. So this guy in what? In Nigeria. So that's that about the foreign subsidiary. So without wasting more time. Okay, I should take that again.
Yes, sir.
Let's assume GTB PLC. GTB PLC or GTB Group acquires another company, let's say Echo Connect. This is an illustration. I don't know if there's anything like that. What did you say? So if GTB Group acquires 70% of Echo Connect and this GTB Group has their base in Nigeria, that is, their operation is being done in Nigeria, their operation, their business operation, every other thing, their head office is based in what? In Nigeria. And the Echo Connect is based in the UK or in the US, for instance. So it means that this is a subsidiary, right? Of course, a subsidiary. This is the what? The parent company. But this kind of subsidiary, is it a partly owned subsidiary? Is it a fully owned subsidiary? Is it a sub-subsidiary? Is it a fellow subsidiary or a foreign subsidiary? Now, because the location is different from that of the what? Of the parent company, this subsidiary is regarded as what? As a foreign subsidiary, because their operation and their geographical location is different from that of the what? Of the parent company. So do you get it now?
Yes, sir.
All right. Fantastic. Olatunji, I have a question for me.
Okay, which means the only difference between local subsidiary and a foreign subsidiary is just geographical location and possibly
Exactly,
the operating currency.
Yes, sir. Exactly, sir.
Okay, thank you.
Exactly, sir. You're welcome, sir. Martins, you have a question for me?
Hello,
So
sir,
Olatunji,
please. I have a question. My question is, I don't understand that sub-subsidiary, like I don't understand the definition and the example.
Okay, the definition and the example. Okay, I said, can you see my screen? You can see this illustration I gave here. This Dangote group and the likes.
Yes, I'm seeing your screen. Yes.
Okay.
Yes.
So a sub-subsidiary is a subsidiary that its parent company is also a subsidiary of a what? Of another entity. In this case, this guy is a subsidiary to Dangote Oil and Gas, right? But this Dangote Oil and Gas is also a subsidiary to what? To Dangote Group. So from that definition, a subsidiary, which is MRS, is a subsidiary in which the parent company, which is Dangote Oil and Gas, this person is their parent company. But in this case now, the parent company is also a subsidiary to what? To another entity, which is what? The Dangote Group. So in this case, MRS is a sub-subsidiary to Dangote Group. Now, we are looking at it from the aspect of the what? Of Dangote Group. Who is MRS to Dangote Group? That's the question. Because MRS to Dangote Oil and Gas is just a subsidiary. So MRS is a subsidiary to Oil and Gas. Or Dangote Oil and Gas is the parent company of what? MRS. But to Dangote Group as a whole, who is Dangote Oil and Gas? Dangote Oil and Gas is a what? Is a subsidiary to Dangote Group. Who is MRS to Dangote Group? MRS is a sub-subsidiary to what? To Dangote Group. You get it now?
Yes, sir. Thank you.
Fantastic. All right, you can put your hands down now. Mercy, I can see hands up. Quickly.
Sorry, you called my name. Before I could say anything, what's her name? Mary or what? She took over. Now ask my question, please.
All right, please ask your question.
So concerning the foreign subsidiary, is there like a standard to guide us on how to consolidate based on the fact that they are?
Yes, and that you follow the prescription of IS 21. Although let's not convince it, you are still following the provision of IFRS 10 and 3. You still follow the prescription of IFRS 10 and IFRS 3. That is business combination and consolidation financial statements. But in addition, you also follow the principle of IS 21. IS 21. So exactly. So in the course of the class, all these will be what will be attended to. So because foreign subsidiary is also another course on its own that will be taken. So exactly. So we regard them as foreign group. So we also do that. Sub-subsidiary as well. There is how we also account for sub-subsidiary. So all this will be treated. Mercy, can put your hands down now. Stephanie, please ask your question. Hello, can you hear me? If you can hear me, please ask your question. Stephanie, your hands are up.
Okay, good morning, sir. Regarding the fellow subsidiary, my network logged me out. I didn't understand what you explained about fellow subsidiary.
Oh, sorry about that. Foreign subsidiary, right? So it's simple.
Yeah.
When let's assume GTB Group in Nigeria acquires another company in Australia. So when GTB Group in Nigeria acquires another company in Australia, so that's, and if they have control over that company there, to them, that company, because they have control, is still a what? It's still a subsidiary. But what kind of subsidiary? It is a foreign subsidiary. Why? Because the location of the parent company where they do business and operation is different from that of what? Of the subsidiary. So in that case, that subsidiary to GTB Group is regarded as what? As a foreign subsidiary. Exactly.
Yes, sir. Thank you.
You're welcome. I can still see some answer. Please, if I answered your question, you can put your hands down so we can be fast. Then Olatunji, no, Mary, I think Mary, have I attended to your question?
Sorry, can you hear me?
I can hear you now. Please go ahead and speak.
Okay. Sorry, please, sir. For a foreign subsidiary, is it possible for a foreign subsidiary to also be like a partly owned? So far is not in the is not in the same country, but the way they are like foreign, like can they also like partly owned or fully owned?
Exactly. So if you can see my screen where there is GTB Group and Echo Connect. So Echo Connect is a subsidiary, right? But this kind of subsidiary is a partly owned subsidiary. Why? Because this GTB Group only acquires 70% and not 100%. Do you get that? And also, apart from being a partly owned subsidiary, it is also a what? A foreign subsidiary. Why? Because their location is different from that of the what? Of the parent company. Do you get that?
Yes, sir. Thank you, sir.
You're welcome. Then lastly, Olatunji, please, your question, then we'll fly.
Please, I'm really sorry for this question I'm about to ask.
No problem,
please,
sir.
From your introduction, when you are mentioning about joint arrangement, something like that, and you attach some standard to it, but I'm looking at the reading material, I'm not seeing the way you explain it. Go to the next page from your listing. Because this is the foundation upon which every other thing will be based. And that introduction, here.
Okay, I'm with you, sir.
Okay, Doc, please can you just do a recap on this, so that because this particular topic is a very complex one, and if this is not we are not well grounded in the introduction, as we are going higher in the whole thing, it will become a little bit complex. Can you just have a recap before you move to complex issues?
Okay, sir. Now, no, this is all this. We believe that all this should have been done in a file in your F file. So this is just like a vision, like I said. And all this, I
Okay.
said, all this will be it affects our group accounts, the aspect of group accounts, one way or the other, one way or the other. So I'm only just doing a random revision because we can't do a revision on everything entirely. It's not possible because it takes a lot. So I'm just doing a random revision of what we have done so far. So this is what I believe we should have done. So we are just doing a random revision. So if you have a specific area where you want me to address, that would have been better. Because if I say let me start addressing everything, one, we haven't still addressing one, then it's leading to one question, leading to another question, leading to another. So we may not finish. We may not finish. And
No problem.
this today is just so, but I will try as much as possible to summarize. Let me just do it that way. A comprehensive summary of all this. I'll do that, sir. Is that fine, sir?
No problem. Okay, thank you.
Thank you, sir. All right. Okay, so before I do that, Michael, let me know your question so before I proceed. Faith or Michael, if you can hear me.
Yes, sir.
Oh, Faith.
So I don't really have a question. I just want to say that, like, please, I'm begging, like, when you're treating something, maybe like try and explain it deeply, because like some of us are not coming from skills. Like me now, I'm coming from I'm moving straight to professionals, you understand?
Okay, I get. Okay, so in that
so
case,
I don't have the knowledge of the FR.
Okay. Wow.
Yeah,
wow.
and our members.
Okay. Oh, I see where Mr. Latunji is now coming from. So I guess that's where Mr. Latunji is coming from. Okay, so
This can you scroll up on this page? No, not this one. The other one. This can you scroll up on the page?
You get material, obviously, after the class. Okay, so you can put your hands down now. All right, so so far we've understand from this aspect to the types of subsidiary that we have. So we understand that, I believe. I'm confident. Okay, so back to this introductory part. Let me just say this. I will implore us to just go through this material. It's just 38 page. So the material is a summary of all what you are required to know in the skill level. It's a comprehensive summary. Just go through it, you understand. And if there is any other thing you don't understand, you can just drop a chat. And drop a chat. It's a whole lot, actually. So, okay, back to this. Let me just even do a quick summary of all what's the applicable standard that is written here. Let me just do a quick recap on it. Now, in line with IFRS 3 and IFRS 10, whenever an entity acquires control, that is more than 50%, of the what? Of the ownership of another entity, by default, IFRS 3 and IFRS 10 requires that entity to prepare what? Group account, or to prepare consolidated account. And our consolidated financial statements is like a replica of our normal financial statements. So we all know that we have the components of our normal financial statements, and they are, so the components of our financial statements are the statement of financial position that shows the financial position of the entity at a particular period in time. Then we have the statement of changes, the statement of other comprehensive income, which is also known as what? Statement of profits or loss and other comprehensive income. So that shows the economic performance of the entity at a particular point in time. We also have the statement of changes in equity. This is a statement that shows the movements in the items of equity of the what? Of that entity at a particular period in time. So whenever there is movement or there changes in the capital structure, or there is movement among the component of equity of the entity, then it is the statement of change in equity that helps us to account for that movement. Then we have our what? Statement of cash flow or cash flow statement. This is a statement that shows what? The cash position, the inflows and outflows of cash at a particular period in time. Then finally we have the what? The notes to the what? To the financial statements or notes to the account. So this is a note that shows a comprehensive position of the accounting standards, the accounting principles that is being followed in what? In the preparation of those other accounts. So it shows the economic events, the circumstances that leads to certain transactions. It shows how some items are being valued or measured. It shows everything. So it is a note to the account that shows that. So this is a component of financial statement of a single entity. So by law, any entity, a reporting entity is required to prepare this account for what? For public review or public use. In view of this, when we also talk about group financial statements, we are also referring to the group or consolidated statement of financial position, that is the financial statement of the parent company plus the financial statement of the subsidiary company, prepared and presented as if they were single economic entity. I believe we can all see my screen. You can see my screen. You see that we have question 2, that the following are the statement of financial position of Sokoto Nigeria PLC, right? This is a financial position. So a group financial statement, or rather specifically, a group financial position is, let's assume this is the parent company. This is just an illustration in this case. This is a subsidiary. So a group financial position is the financial position of the parent company, which is this part, this aspect, plus that of the subsidiary, which is this aspect. So the two of them will now be consolidated together and prepared and presented as if they are what? A single economic entity. So consolidation or group. Let me say group. So it means that upon consolidation, this will be added to this. 26 plus 560 will give us 3,110, if I'm not mistaken. This plus this will give us 2,000. So in the process of doing this, adding up, we are doing what is known as what? Group financial position. So therefore, if you now remove all this, you are now showing for plant and machinery, you are only showing the figure of 3,110. Then for furniture and fittings, you are showing 2,000. Then in that case, what you have just done is as you have prepared a group financial position. Although there is other things being included, there are procedures in doing that, but I'm just showing us simple terms. Also, there is also group or consolidated statement of other comprehensive income. it is the statement of profit or loss of the parent company plus that of the subsidiary company prepared and presented as if there is a single economic entity. So the same principle also apply when you have financial statements, the profit or loss, or rather the revenue of the parent company will be added to that of the subsidiary. Revenue of the parent company will be added to that of the subsidiary. Cost of sales of the parent company will be added to that of the subsidiaries. Then, likewise, the other income of the parent company will also be added. So I believe you can see my screen. So in this case now, a group statement of profit or loss will be the revenue of parent company added to the revenue of the subsidiary to give us a group position, which this will now be 660. This will be 260. Then our gross profit in this case will be 400. Then you add this together, here there's 0, here will be 20, and so on. So this position is a group statement of profit or loss, another comprehensive income, or a consolidated statement of profit or loss. Likewise, we have consolidated statement of changes in equity, whereby it consolidates the equity component of the parent company with that of the subsidiary together. Consolidated statement of financial position, consolidated statement of cash flow, consolidated statement of cash flow. We do that. Then we also have what? The necessary disclosures that accompanies our group financial statements. Now, this is done in line with IFRS 12. IFRS 12. So indirectly now I'm explaining the IFRS 12 in this part. So that's disclosures of interest in other entities. Disclosures of interest in other entities, IFRS 12. So IFRS 12 is a standard that gives us the necessary disclosure requirements that we need to disclose if we have interest in other entities. We get that. So these are the various group accounts that we have, or group financial statements. So each of them has their own principle and guidelines that we need to follow when preparing them. So, but let us bear that in mind. So why do I give us that illustration? Why do I bring all this? That is needed for this IAS 27. Because by default, like I said earlier, once you acquire control, you are required to prepare what? Consolidated financial statements. However, there are exemptions to some people or to some companies from preparing consolidated financial statement. There are exemptions. Now, there are only two exemptions in line with the standard. Let me just, it's in the material, but let me just keep it down here. So the first exemption is that if that entity, please mute your mic. So exemptions to preparing group accounts. So the first exemption is that if that entity is what? If the parent company rather, if the parent company is an investment entity. So if the parent company is an investment entity, then you are exempted from preparing what? Group accounts. So you can decide or choose not to prepare group accounts. And when we say investment entity is a company that only invest funds for what? Investment purposes. So they collect funds from their clients and what? Invest those funds in order to what? To give them what? Returns from investment, or to provide them with what? With investment services. So those kind of companies are referred to as what? Investment entity. Now, this investment entity may choose or not choose to prepare group accounts. However, if the parent company is not an investment entity, it can also choose not to prepare group accounts. However, it will not prepare group accounts based on certain circumstances. I'll give one and I'll go back to the notes so we can read it out because of time. So the first one is that although they are not an investment entity, but the parent company is a subsidiary to another entity. So this is just in short. So we are not saying that this company, they are not investment entity, but however, for them to choose not to prepare group accounts, it must be that one, the parent company is a subsidiary to what? Another entity, and the other owners has agreed to what? To the company not preparing what? Preparing group accounts. And you will find this mostly in what? In the case of what? Subsidiary. Back to this illustration here now. Back to this illustration. Dangote Oil and Gas is a parent company, right? Because they also have shares of more than 60% in MRS. In this case, Dangote Oil and Gas, who is a parent company, may choose to not prepare what? Group account. Why? Because they are also what? A subsidiary to another company. And this company in which they are what? Subsidiary to, they would have what? Prepared group accounts in line with what? With the applicable standard, or in line with IFRS 10, IFRS 3. Please, do you understand that?
Yes, sir.
So, the other conditions, let me quickly dive into that. There are 4. So, the other condition is if the parent company does not have their shares quoted in the stock exchange. So, if their shares or their stock is not what? Their shares is not being quoted in the stock exchange market, they may choose to what? Not prepare group accounts. That's the second condition. The third condition is that they are not in the process of filing. They did not file, neither are they in the process of filing their accounts with the what? With the Stock Exchange Commission. So in that case, they can choose not to what? Prepare group accounts. So this is it. This is the part I'm looking for. Then lastly, the ultimate or parent company. The ultimate or intermediate parent company has what? Prepare consolidated financial statement that comply with what? With the prescription of what? IFRS. So all these conditions, if all these conditions are in place, then that entity may choose not to what? Prepare group account. So those are the conditions or exemptions to an entity from preparing group account. All right. So when we read through this material, we see it here. Now back to this part. back to this part. If an entity does not prepare group account, that entity is required or can choose to prepare what? Separate financial statements. That's where this standard is applicable. What it means is that whenever you are not preparing group account and you have control in another entity, you can prepare separate financial statements in line with the provision of what? IS 27. And how do you do that? That's the next question. The standard says that if you are preparing separate financial statements, you account for your investments in that other entity, either at what? At cost. Either at cost. So that is, I hope you guys understand this note. I'm just paraphrasing. That is, your investment in subsidiary investments in associates or joint venture, then your minor, no, let me not put minor investment. So your investments in associate investments, okay, will be accounted for at what? At cost. So you just account for it at cost or at fair value in line with what? IFRS 9. So in this case, you follow the provision of, in this case, your minor investments will fall in this category. So
Miss,
meaning
can you
that,
repeat this part again? Sorry.
okay,
Please repeat this thing.
An entity that is not preparing group account, right? Because it's not preparing group account, it's required to prepare what? Separate financial statements. Now, you are not preparing separate financial statements. How do you account for your investments in what? Subsidiary? Or how do you account for your investments in associates or joint venture? Or how do you account for your minor investments? That's the question. So, in line with the provision of IS 27, those investments will either be accounted for at cost or at fair value. That's what they're saying. So, if you account for your investment in subsidiary or investment in associates, you account for it at what? At cost. If you are accounting for your investments, your minor investment or your simple investment, you account for it at what? At fair value. That's what they're simply saying. Do you get? You are just preparing your normal financial statements. But in this case, the investment you have in subsidiary, because you are not preparing group account, you account for it at cost. And your investment in your simple investment or minor investment, you account for it at fair value. Do you get that? So that's that for IS 27. That's what we are required to do for IS 27. Then IS 28, I've explained that. Hello, Alatunji.
I'm with you.
Your hands are up.
No, my
That's a
hands
mistake.
not up.
I raised my hand, sir.
Okay, Alatungo, please ask your question.
You said where a PC is preparing a separate financial statement, its investment in the company can be accounted for at cost or fair value. So you're saying for the joint arrangement, that means where he has 50%, it will be at cost. And where he has less than 20% will be at fair value. Is that correct, sir?
What I did not bring in, I specifically or intentionally did not mention joint arrangements. I did not mention joint arrangements because joint arrangements has a separate standard that addresses that. So I will explain. When I explain that part, you get it. So if you are if you are jotting down, please don't include joint arrangement so you don't get it confused. So you only include investments in associates or joint venture.
Okay, sir.
And when I'm explaining that, you get why I said that.
Okay, sir. Your notes read investment in subsidiary. Oh, you're just taking your note home. Hello, sir.
I'm with you, ma.
Yeah, can you go scroll to your notes, please? You said investment in subsidiary, investment is associate or joint venture will be accounted for at cost or fair value. Is okay that way?
Yes, ma. Will be accounted for at cost. Or then I put, okay, just remove this or so that you won't get it confused. I'm just writing randomly, that's why I put or. So the investment in subsidiary and joint venture be accounted for at cost, and your minor investments, put it that way, and minor investments will be accounted for at fair value. So put that statement that way. It's because I'm writing randomly, that's why I put it that way. And the minor investments or simple investments will be accounted for at fair value. Are we good?
Yes, we are.
Okay, Modupe. Modupe, please, you can speak.
Fair value.
I can hear you now. I can hear you now, please.
Fair value. Then you said IFRS 9, and I thought fair value is IFRS 13. So that's why I'm confused, please.
Okay, wow, that's good. Thank you for the observation. Now, when you talk about fair value affects different aspects of our financial reporting and corporate and strategic business reporting. So
it's clear. It's clear.
It's going blank again. So sorry about the interruption. So someone asked a question that the person is seeing fair value. I wrote IFRS 9 that was fair value not supposed to be in line with IFRS 13. So I guess that's the part I was explaining. So you are right, IFRS 13 deals with fair value measurements, quite right. But however, like I said earlier, IFRS 13 is applied to other aspects of each of our standards. IFRS 13 only gives us the basis of measuring fair value. So it gives us the basis of measuring fair value. But in other standards, they gives us how we apply or how we make use of that fair value in our accounting records. We get that. So that's why in other aspects, you always see fair value. You see fair value in PP, investment property, in agriculture, IS 41. You see it in IS 38, intangible assets. You see fair value in IS 36 in all aspects of the standard. One way or the other, you must see your fair value. So in IFRS 9, financial instruments. We have various ways of measuring and valuing our financial instruments. And one of the ways at which we must measure our financial instruments is at fair value. The standard says that financial instruments should be measured at fair value. And that fair value can either be at fair value through profit or loss, or at fair value through OCI. Do you get that part? So the fair value I'm referring to as in this case is the fair value in line with what? With the provision of IFRS 9. Fair value in line with IFRS 9, and not the fair value of what? IFRS 13 itself. The IFRS 13 in this case is as a result of the fact that there is no how we want to deal with this standard that we will not make mention of fair value. So it means that the knowledge we have in our fair value measurements will help us when we come across fair value. And we all know that fair value is the price that we received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So that's fair value. So the IFRS 13 in this case is just the definition and the measurement of fair value. But the other one in this case I am referring to here is the what? Is the measurement in line with what? IFRS 9. Does that answer the question? So I hope you are clarified on that, ma.
Thank you, sir. Thank you, sir. Fine.
Okay. So that's for IAS 28. That's for IAS 27 rather. Then for IAS 28, we are mentioning about investment in associates and joint venture. So let's leave out the joint venture aspect out of it first. Let's concentrate on the investment in associates. I said that before an entity can be regarded as an associate, or before you can call an entity your associate, you must have acquired above 20%, right, of the equity shares, but below what? 50%, or below 50%. So in this case, you have significant influence over that entity, and this significant influence will make that entity your associate. So when you are accounting for your investment in associates, I tell us that the standard says you should account for them initially at using the equity method of accounting. That's what the standard says. That we should make use of the equity method of accounting to account for our investments in associates. And I explained how they guide us on doing that. They said that upon initial measurement, it should be accounted at cost. Then subsequently, it should be what? Adjusted for the what? Post-acquisition profits of that what? Of that associate. Back to this joint venture. So before I can explain this joint venture, let's go back to IFRS 11, joint arrangements. Now, there are certain situations or circumstances whereby two or more entities or three entities can come together to what? To jointly share control. Over an arrangement or over another entity. Do we get that? So entity A can collaborate with entity B that let's jointly put resources together so that we can have joint control over a particular entity. So in that kind of situation, it is referred to as what? Joint arrangement. So whereby there is 50%. So they acquire 50% ownership. Now, that 50% acquisition of ownership is not in isolation, because someone asked that, is there a situation whereby there is no control, that is no one specific person has control over another entity? So, and I said it is rare that one way or the other, there must be control, because where there is no control, then that kind of business cannot make progress where there's no control. So to help us explain that joint control better, let's look at this illustration 2. I believe you can see my screen on this aspect of illustration 2. Now, when it comes to group accounts, it is assumed that the control will come in place whenever the entity acquires more than half of the ownership interest of another entity. That's the simple way, or the best way that is well known when it has to come with group accounts. But however, we should know that there are also certain circumstances whereby control can exist, and not necessarily the acquisition of of more than 50% ownership. So I think in this material, I also established that fact there. So when you read through, you will get that part. So as I was saying, there are also circumstances whereby you may not acquire more than 50%, but you still have control. You still have control. In this illustration 2 now, the first one says that entity A has 60% of the equity share of B. So the requirement is just to tell us what kind of relationship exists in this case. Now, for the illustration 1, or for the number 1, the kind of relationship that exists is what? Is the parent and subsidiary relationship, because in the absence of any other information, the 60% ownership gives A control over B, meaning that A is the parent company, while B is is the subsidiary of A. That's the first illustration. The second one, A has 45% equity of the share of B. Likewise, in the absence of any other information, it is assumed that this information is what is available, and this 45% only gives A significant influence over B, meaning that A is the parent company, while B is is the associate, right? B is the associate of of A. Are we getting it? Likewise, in the same way. So, okay, now let me be applying the standard that applies. For the first one, you apply full consolidation by following the requirement of IFRS 10 and IFRS 3. For the second one, you follow the principle of IAS 28, investment in associates, by applying the equity method to account for that investment in associates. For the third one, we said that A has 15% of the share of B. What does that mean? It means that in the absence of any other information, the investment A has in B is just a minor investment. So A can try to call entity B as as a minor investment, or a simple interest. That's simple interest or minor interest. In this case, you apply the principle of IFRS 9. So you account for it as a normal financial instrument, right? Then for the next one, 4, A has 50% of the equity share with a joint control in B Limited. Are you seeing what we are seeing? Or are you seeing what I'm seeing? A has 50%. This is exactly 50% of the equity share, and not just 50%, with a joint control in in B. So this kind of situation now, this is a B Limited is a joint arrangement of A. It's a joint arrangement of A. So A is the entity that has joint control in what? In B. So A with another entity agrees to what? To jointly control B. To jointly control B. So this one is outside the scope of IFRS 10. It is within the scope of IFRS 11, joint arrangements, right? Now, when we say joint arrangements, let me come back to the up slide. So these joint arrangements can either be joint operation or joint venture. Are we seeing where the joint venture is coming from now? The joint arrangement is either joint operation or joint venture. The joint operation will be accounted for in line with the provision of IFRS 11. And when we say joint operation, what does it mean? It is an arrangement whereby two or more entities agrees to what? Jointly share control over the assets and liability. Over the assets and liabilities of what? Of another entity. So in this case, they will both share the assets and also share any liability or obligations that may arise in that what? In that other entity. Do we get that? That is joint operation. So you share the assets equally, both. So when you're accounting your book of accounts, the assets will be what? Will be allocated on equal basis. On equal basis. Do we get that? Chiamaka, before I proceed, what's your question?
Okay, so I'm a bit confused.
Okay.
These joint ventures in investments and associates, what's the difference between that one and the one in joint arrangement? Is it the same thing? Because I thought investments and associates.
It's the same thing. That's what I'm saying. It's the same thing. I said, if you remember, I said, do we not see where the joint venture is coming from? And what I meant by that statement is, can we see this joint venture here now? That it is from here that this joint venture is coming from. So, and the reason why we have joint venture here is because under the joint arrangement, the joint operation will be accounted for in line with IFRS 11, but the joint venture will be accounted for in line with IAS 28. You get it now. So that's why we just include investments and associates and also joint ventures. So, but IFRS 11 gives us the definition of joint arrangements and gives us the possible types of joint arrangement that we have by establishing the fact that the possible type of joint arrangement that we have can either be joint operation and joint venture. IFRS 11 now goes ahead and says that for joint operation, you will apply my principle, that is the principle of IFRS 11. But however, if that arrangement is a joint venture, the standard say please account for it using the principle of what? IAS 28. Chiamaka, do you get that?
Yes, sir.
And
Thank
also
you.
the class, I'm sure we
Yes,
are
sir.
following. I'm following on that.
Yes, sir.
So, you want to say something?
So what's the difference between the joint operation and joint venture?
Exactly.
I want to know, is joint operation the one is? Yes.
So, fantastic. I like that question. The difference between joint venture, joint operation, difference between joint operation and joint ventures is simply the kind of arrangement involved, or simply the nature of the arrangement involved. That's circumstance. When we say joint operation, the joint operation, the parties in the joint arrangement have rights to both the assets and liabilities. Both the assets and liabilities of the what? Of the joint arrangement. And in this case, no separate legal entity is formed. No separate legal entity is what? Is formed. What does that mean? It means that I, as a person now, or me as an entity, now let me know myself as a person, because we are talking from the viewpoint of an entity. I, as a reporting entity, agrees to have a joint arrangement with you. Now, in that case now, we now come and say that because maybe you have what I need and I have what you need, so we now come together and I say, okay, for the time being, let's have an arrangement that we can be sharing control over a particular entity. So we are not establishing a new policy. No, nothing is coming. So we just want to have business together for a time frame, for a certain time frame. Then, if the asset that we have, if we have an asset in that arrangement, then it is good for us, it is for our benefit. But however, if we have an obligation that arises from that what? From that establishment, then in that case, we also what? Bear out of that what? Obligation. We both suffer for it. Both suffer for it. That's for the joint operation. But however, for joint venture, now, the parties have rights to only the net assets. Only the net assets. What that simply means is that any obligation that arises from that arrangement, they will not bear from it. And in this case, there is like an establishment or there's a separate legal entity in that arrangement. So in a joint venture, the parties have rights to the what? To the net assets. But in a joint operation, they have right to both the assets and the what? And the obligations, which is the liabilities that may arise from what? From that operation. So the difference between two of them is largely on that thing, on those two things, and also the mode or nature of the business. Is that clear? So for this, you account for it using the principle of IFRS 11. For this, you apply for using the principle of IAS 28, investments in associates and joint ventures. Do we get that now? So that's for that. Okay, so we have explained that IFRS 11 now. Do we get that? Then back to this part. IFRS 10 is the basic business combination itself. So you must prepare consolidated financial statements if you have control over another entity. You must prepare full consolidation. So IFRS 10 and IFRS 3 usually goes hand in hand, because IFRS 10 is as a result of what? IFRS 3. You get? There's no way you are preparing consolidated financial statements if there's no what? Business combination. There's no way. So IFRS 3 gives us the definition of a business combination and also the measurement and recognition criteria how to recognize assets that arises from a business combination, how to recognize the liabilities or obligation that arises from a business combination, and also how to recognize other assets that is prohibited individually but is what is recognizable when there is what business combination. And a very good example is what is our goodwill. Our goodwill. Let me take us back to IS 38. In line with the principle of IS 38, goodwill should not be recognized as an asset in the book of the reporting entity. So IS 38 prohibits us from what? From recognizing goodwill in our financial statements. But when that comes to IFRS 3, upon business combination, IFRS 3 now says that you can recognize that goodwill because that goodwill arises from what? From a business combination. So that all those things are addressed by what? By IFRS 3, the measurement of goodwill and the like. So those are the aspect of our standards that we should know. Also, we should not forget that there are necessary adjustments and procedures we need to follow when we are preparing either consolidated financial position, consolidated profit or loss, consolidated statement of change in equity, and consolidated cash flow. So the consolidated statement of cash flow is addressed by IAS 7. So that is another standard entirely. Let's just quickly do our time. Okay, then I saw this part. So I was trying to explain something here. So now let's now look at IFRS number 5. Let's look at this illustration 2, number 5. The standards, the question says that A has 75% in the equity share of B, with 2 members out of 5 directors of B. Now, take notes. If the question has stopped here with no any additional information, meaning that they say A has 75% in the equity share of B, full stop. So we can quickly conclude. So know the percentage holding of A in B and conclude that A has 75% ownership in B, thereby giving A control, and B will now be the what? Subsidiary of A, while A is the what? Parent company. But however, they did not stop there. They now give us that, they now give us additional information saying that they have what? 2 members, meaning A has 2 members out of the 5 directors of B. What does that indicate? It means that there is other possibility of what? Control. That we should not just look from the mere surface. We should look beyond the mere surface and dig deep to actually investigate and come to the facts as to whether or not A has control in B or not. Now, we will not judge by saying if A has 2 members out of 5 directors, how many percentage in aspect of control does A have? Simple, by saying 2 divided by 5 times 100, and that will give us how many percent?
40%.
40%, right? So meaning that in this illustration 5, A, although is a parent company, does not have what? Control. B is what? In this case, okay, let me do it this way. A is the parent company, quite all right. But however, A does not have control. Rather, A has what? Significant influence. have significant influence in what? In B. Thereby, B is an associate of A. They will apply the what? The equity method of IS-28 to account for this our investment in A. Please, do we understand that?
I don't understand. I don't understand.
Okay, I'm saying that I said something earlier. Remember that in group accounts, control is assumed to what exist when they acquire more than what 50% of the equity share of another entity. But I said, however, sometimes there are certain situations whereby control exists and not necessarily by just acquisition of what more than 50% equity share. So, but for group accounts, we're only concerned about 50% acquisition, more than 50% acquisition. But for circumstances whereby the examiner want to test beyond what the normal thing that we all know, if they want to test it beyond that, they can now go beyond that and test the other ways control might exist. So the other way control might exist is when the parent company does not acquire more than 50%, but has what representative in the subsidiary company. All those representatives are seen to be what? Key management personnel. Key management personnel. So if they have more than half of the total key management personnel of the subsidiary, then control exists, and not necessarily by the acquisition of more than 50%. Another good example is that of Dangote Group. Take for instance the man Aliko Dangote. Aliko Dangote is also an investor, right? He's an investor in what? Dangote Group, part of the investors of Dangote Group as a whole. But you agree with me that he's not the only investors. He's not the only one that has investments or interest in that Dangote Group. There are other investors. But however, Dangote, Aliko Dangote, the man himself, has controlling interest because he's the one that has more upper hand. Although it may not necessarily, though I don't know, in real sense, it may not be so, but it may not necessarily be the only one that has maybe the highest funds or equity rights in terms of equity share. It may not be the one, but he has representative, the highest number of representatives across the board. So in that case, that makes him makes him to have control over other subsidiaries of the group. Coming back to this, meaning that if you see a question like this and they now give you additional information as relating to either board of directors or representative or key management personnel, and they tell you that they have blah blah blah, like they state it here. Please, can everyone hear me?
Yes, we can hear you now, sir.
All right. It's back. As I was saying, it's back. All right, good. So, like I was saying, I said that when you see information like this, that they give us 70%, they now give us an additional information. It means that that first information is no longer relevant in determining whether control exists or not. Rather, the other information that has to do with either members of the board or representatives or key management personnel, as the case may be, depending on how the examiner framed the question, is that information you use to determine whether or not control exists. Now, here they are saying A has just 2 members out of 5 directors. It means that the other 3, because in a setting like this, before you can make decision is made based on votes, right? Make based on votes. So everyone will vote, and in the total number, the highest voters will has the final say over either the economic decision of the company or the investing decision or operating decisions. Now, say for instance, A acquires 75%, but A has just 2 members out of the board of B. Now, there are now decision that is placed that let's do certain things. Let's vote. Let's cast a vote. A has 2 members. The 2 members voted for something else. The other people has 3 members. 3 members voted for something else. Please, who has the final say? The one
3 members.
The 3 members.
3 members.
The 3 members.
In that case, it means A does not have control. That's what it means. It does not have control. So, in determining the percentage holding, and determining the what percentage holding or the whether control exists, you will not look beyond the first information. You now go into the second information by saying 2 divided by 5 multiplied by 100, so 40%. So it means they don't have control. Rather, they have what? Significant influence. They have significant influence. Do we get that?
Yes, I
Then
think.
for this number 6, the same thing applies. A has equity share of B with no member in the representative. So it has no member, meaning that B is what? It's just a simple investment. Don't be so. Simple investment. Because 0 divided by 5 is equals to 0. So that's just a simple investment. Then the last one, A has 40%, but 3 out of the 5 directors, 3 over 5 times 100 should give us 60%, right? Or 70.
Hello, sir.
Yes, sir. So 60%.
Yeah,
so in this case, how much is that?
Can you hear me? Yeah. So I thought
you,
simple interest was from 0.1% to 19.9.
Yes.
So having 0 does it to mean we have simple interest?
You know,
simple investment.
Zero in this case is to know whether control exists or is just significant influence or is just simple investment. Meaning that you have 0 to 19%. That's what it means. Although it's not necessarily meaning you don't have anything at all. For you to acquire 60% means you paid something. So it's just like just having manual investment. I just want to make investments. I'm not concerned about I'm not concerned about the operating or financing decision of the company. I'm not bothered about that. What I am interested in is what is returns on my investment. That's what I'm concerned about. Let me bring my money, let me acquire part of your shares, and at the end of the year, you pay me dividend. So I have returns on my investment. So in that case, although you don't have representative in the board, you don't know anybody there, you just want to invest. So in that case, you have simple investments. So that is 0% is to determine whether there is control or significant influence or it's just a simple investment. Do you get? So you can also say, all right, sir.
Hello, sir. Your laptop may need charge.
Oh, that's true. How many percent is this? 17, my goodness. Please just give me some minutes, maybe five minutes, please. Lanchidi, please.
Okay,
I'm coming. I'll attend to your question soon. Okay, so can everyone hear me now?
Yes, sir.
Yes, we can hear you, sir.
All right. Mr. Latunde, you have a question for me?
Okay, my question is, if you look at 6, does it mean that the company A does not have interest in running the affairs of company B? So it's more or less like they're just investing based on the opportunity they see in B, just for the returns and not for control.
Exactly, sir. That's it, sir. Exactly. You get, sir. So that's it. Mr. Solomon.
Yes, sir. Sorry, as I'm still confused as to why number 6 is still simple investment.
Yes, because we said that
Because,
a simple investment.
sorry, because at the end of the day, what the calculation you did is that, okay, let me go with this 75, number 5. We have 3 over 5. If you divide it, we have 0.6, right?
Yes, sir.
So is it the 0.6 that we are looking at, or the end product of 60% to determine if it is simple or not?
It's the 0.6, the 60%.
Okay, 0.6. Okay.
Yes.
Because 0 to 19 is a simple investment.
Yes, exactly.
Okay. All right. Thank you.
Welcome, sir.
Yes, sir.
Okay. So all these are just time. Okay, let me see. Let's quickly progress further. So by now we already have a standpoint or an idea of what group entails for those that are coming from that are not coming from through the skill level. So I've explained these exemptions, investment entities. So, but when we go through this material, the material is very useful and very relevant to guide us for the revision aspect, to just refresh our memory on the group account. So then rules for effective consolidation. So before we can have an effective consolidation, there are certain things that must be in place. The first thing is that there must be uniformity of accounting policies. Yes, the accounting policy of the parent company must be in uniformity of that of subsidiary company to have an effective consolidation. In a situation whereby it is not so, then there's a need to carry out necessary adjustments to ensure that they are on the same accounting policy that is to be applied.
This one at this.
The next one is
this NEPA, right?
The next one is common or similar reporting dates. So the parent company reporting dates and that of the subsidiary must be the same for effective consolidation. So if they are not the same, then there is need for the subsidiary to prepare a separate account that has the same the same reporting period as that of the parent company. So you must prepare that. But if in a situation it is impracticable and impossible to get the financial statements that has the same reporting date as that of the parent company, then the financial statement can be they can make use of it like that and consolidate just like that, provided the reporting date gap is not too lengthy. So if it's not more than 3 months, then you can just consolidate it like that. But however, if it's more than 3 months, then there's need for additional adjustments There's necessary adjustment that must be made before consolidation. Then also, we must be able to identify the dates of acquisition, or rather the date of inclusion of the subsidiary in the group structure, and also the date to stop including our subsidiary in the group structure. The date of inclusion is the date whereby the parent company acquire control over the subsidiary, and it is also known as the date of acquisition. And we normally use an acronym for it, DOA, date of acquisition. And the date we stop including our subsidiary is the date whereby the parent company lost control, and not necessarily the date of consolidation. So it's just the date that the parent company lost control over the subsidiary company. All right, now let's come on the aspect of financial position, because group financial position or group financial statement is more complex as compared to other form of group financial statements. So it has various adjustments that are necessary. So now for effective consolidation of our financial position, there are these principles we must follow, these procedures that are listed here is what we follow. The first thing is we need to determine the group or the percentage holding. So that percentage holding will enable us to know if there's control or not. So that percentage holding most times is expressly given, but sometimes it will not be given. Then we are the one that needs to what? To calculate it ourselves. In a situation where percentage holding is not given, then the percentage holding will be calculated by saying total number of shares acquired, by the parent company over total number of subsidiary shares multiplied by 100/1. So this will give us the percentage holding of the parent company in the subsidiary when it is not expressly given. So having done that, we need to draw the group structure. So draw the group structure. A group structure is not something complex. The group structure is just to show the composition of our what? Of our group setting. This is A. A acquires B. The percentage holding will be stated, say 70%. So this is what? Group structure. And this kind of group structure means that we only have what? One subsidiary in this case, which is B. And it is a simple what? A simple group. The simple group. We have complex group, we have D-shaped group, we have foreign group. So the structure will help us to determine which type of group it is. So this one I just as one subsidiary or two subsidiaries is a simple group. Then the next one is to perform double entry record for individual company adjustment that might be necessary. So what it means is that we need to carry out necessary calculations and adjustments that are required for the purpose of effective consolidation process. What it means is that there are some adjustments that is required in this case. And one of the adjustments is intergroup balances. Another one is unrealized profits. Another one is the calculation of goodwill. Okay, this is it here. Intergroup balances, unrealized profits, inventory, and non-current asset transfers. So all these adjustments are necessary. So they're necessary. So all these ones too are required. That's for that. We'll look at it. I'll find a way. There's no time, but I just put for direction, so we know how to just go about it. So you can perform the necessary adjustments. Then the next thing is to calculate, although not necessary, the adjusted retained earnings of the subsidiary as at date of consolidation. So please take note, this part is not necessary. You may choose to include it as the next step, or you may choose not to include it and move directly to this part. What I teach my students, or what I do, is that I follow how ICAN does theirs. When ICAN are providing solution, they usually does not include this part, this third part, this part. ICAN will not include it. So, but there are some tutors that teach it, and there are some students that use it. ICAN does not penalize it, but so that we can have a basis whereby when you are solving past questions, when you solve it yourself and you compare that with ICAN solution, you can have a ground and be confident. So it's not that you see different things and you now be wondering. So you can know that this is where ICAN is doing it, you do it your own as well, you arrive at the same result. If you add it, you get the same result. If you don't add it, you still get the same result. So do we get that? Then back to this part. The next thing is to calculate the net asset of the subsidiary. Net asset of the subsidiary as at date of acquisition and date of consolidation. So that's remind me of something. When we are preparing group accounts or group financial position, we only consolidate the assets and the liabilities. We do not consolidate the what? The equity component of the subsidiary. We do not do that. So the equity component of the subsidiary will be used to arrive at our what? Post-acquisition profits. And that's where this part is. So this part that we are talking about, net assets, is simply the capital component or the equity component of the subsidiary. So we don't consolidate it. It will not show as part of, not show on the face of our consolidated financial position. It will not show. So you only treat it as net asset. So we calculate the net asset as a date of acquisition and date of consolidation. And the purpose of calculating your net assets is, one, to determine the post-acquisition profit. To determine the post-acquisition profit. So the net asset is also referred to as what? Capital and reserves. Also referred to as capital and reserves. So the purpose is to calculate the what? The post-acquisition profit. We have DOA, we have DOC, then we have the post-acquisition profits, if any. So what are the elements that comprises of the net assets of the subsidiary? So just your capital structure. Start with that first, which is our equity share capital, your retained, your share premium, if any, the share premium, then the retained earnings. So at this level, we can now start including other components of reserve, other equity components. Other equity components, very necessary at this level. So what is the position as at the date of acquisition? compared to the position as at the date of consolidation. This is A, this is B, the C is equals to B minus A. So I can sometimes refer to this as reporting dates and acquisition dates, as this place acquisition dates. So, and it should be noted that the equity share and the share premium does not change as at both acquisition and as at consolidation. So making this part of the what to be zero. So in most cases it does not change, just still the same as at beginning, the same as at end, leading to zero. Then for retained earnings, it will usually change. That as at the beginning will usually be different from that as at the end, leading to a profit. But if it is a reverse, then we have a loss. Then other equity component as well. Other equity component as well. So other equity components can change or not change, depends. So let me just assume it can change. Now, this is what you should not forget. Entire of net assets, always have this at the back of your mind. Then there's now other adjustments that will be made to net assets. And it's very simple one, what fair value adjustment. Fair value adjustment and other adjustments. Let me keep it simple. Other adjustments. There's some other adjustments that will come. So then either positive or negative, either positive or negative. So this will give us our net assets, either positive or negative as well. So that's for the next part. Then the next one is the calculation of goodwill. Priska, you have a question for me?
Yes, sir, please. I just wanted to confirm. You were saying that that DOA is known as reporting dates and DOC is.
Yes. Consolidation dates.
Okay, sir. Thank you.
You're welcome. So the next thing is what? Calculate computation of goodwill. So now we'll look at it shortly. Then the other one is what? We need to now calculate our what? Non-controlling interest. Because you agree with me that I usually say something that the subsidiary has two owners. The first one is what? Controlling owners or the controlling interest owners. Then the other one is what? Non-controlling interest owners or shareholders. So these ones are known as what? The parent company, while these ones are referred to as what? No NCI, no controlling interest. So because we are consolidating this subsidiary as part of our financial position, so we need to also represent the other non-interest shareholders shares, shareholders position. Let me use that word. So what is their own position or their own interest in that subsidiary? So we need to show it so that our group financial position will show a true and fair view of what is being represented. So that will bring us to the computation of what? NCI. Then lastly, we need to calculate our consolidated retained earnings. So the consolidated retained earnings is the retained earnings of the what? Of the parent company with other adjustments that is being made. Then we now have the next steps to now prepare the group account itself. Group account itself. So without wasting much time, we have just few minutes left. I thought we'll be able to solve like 3 questions. So the idea I have was that It's something we are familiar. Let's just run and not realizing that we also have some other people that are not coming from skill level. So sorry about that. But within the next few minutes, let me see how we can achieve calculation of goodwill, because it's very, very important. Calculation of goodwill is very, very important. So I think we can stop there. Then, and I advise us to go through the materials. If you have any further questions, just reach out.
How do you go through?
So what? Are you talking to me? So let's try to mute. If you're not saying anything. Okay, now, in line with IFRS 3 business combination, they gave us the definition of a goodwill. Because earlier I said something that IFRS 3 gives us the recognition of assets that arise from business combination and the liability that will be assumed, and also the recognition of other assets that cannot be individually recognized by other standard because they are prohibited. So, and I said that a good example is our goodwill. So, how does IFRS 3 addresses goodwill, and how do they define goodwill? IFRS 3 says that goodwill is an asset that represents future economic benefits arising from other assets or arising from other assets acquired in business combination, or just in short, you can say it's an asset representing future economic benefits arising from a business combination, that are not individually identified and recognized. So that's goodwill. How do we measure goodwill? Or rather, how do we recognize goodwill? The standard says that goodwill should be recognized as an intangible asset, intangible, non-current asset. So that's where we recognize goodwill in our financial position. And it should be what? Presented separately. So it should be presented separately on the face of our consolidated financial position as a line item. So you always have goodwill. After when you have your non-current assets part, you have your PP, if you have your investment property. So after all this, you now have your goodwill as well as a line item. So this will be done as a way of workings. We need to work it out and calculate it ourselves. Sorry about the background noise. So that's the recognition of goodwill. Now, how do we calculate or how do we measure goodwill? The standard says that goodwill should be measured at fair value. Have we seen where fair value is even coming place again? Have we seen it? So goodwill should be measured at fair value on acquisition. Please take note of that. On acquisition date, we should measure our goodwill at fair value. But subsequently, goodwill should never be amortized. We do not amortize goodwill, but rather it should be tested for impairment. So we are more interested in the part of the measurement of goodwill now. So that brings us to this calculation of goodwill. Another definition we can give to goodwill is that it is the excess of the purchase consideration over the identifiable net assets of the subsidiary. I put it that way. So goodwill is the excess of the purchase consideration over the identifiable net assets of an entity. What it simply means is that you have a purchase consideration. You have a purchase consideration, then you have the net asset. In this case, the purchase consideration represents the amount that is paid or the consideration that is transferred from the parent company to the subsidiary to acquire the subsidiary. Let's say this is 200 million. And then the net asset represents what the subsidiary was. So represent what the what or the worth of the subsidiary, let's say 150. So we're not saying the excess of this amount to pay over what the worth is what goodwill, meaning that the worth 150, but you are willing to pay higher than what the worth. You're willing to pay higher. It's not that you want to pay higher. It's because you know that they have something. They have a goodwill. They have a reputation. They have a good customer base. They have a database. They have connections. Whatsoever the factors may be, that factor is seen as a goodwill that makes that what entity to stand out. And that's why you are willing to pay what higher. So that excess represents what the goodwill. And in this case, this goodwill is usually seen as what positive goodwill. So this is the calculation of a simple way to calculate goodwill. Purchase consideration over the net assets of the subsidiary as at date of acquisition, because we are dealing with acquisition now, goodwill. So upon initial measurement, goodwill should be what? Measured at fair value. So this is at DOA. Therefore, this is the goodwill that we have at date of acquisition. So subsequently, we said that goodwill should be tested for impairment. Goodwill should be tested for impairment. So meaning that if you test the goodwill and you discover that the goodwill is impaired, you also consider the factor of impairment. Let's assume the goodwill was impaired by 10. Then you subtract that amount. The resulting effect is also goodwill, but this is a goodwill at the date of consolidation. So this is the goodwill you have as at when you are consolidating or when you are preparing consolidated financial position. Meaning that if you acquire the entity for a particular reason, maybe because they have a goodwill, and that goodwill is attributable to the fact that they have good customer base. They have good customer base, so that's why you acquire them. So you acquire them in January. Then as at December, you agree with me that from January to December, a lot would have happened. A lot. Let's say, for instance, there is now unforeseen circumstances, or rather there are some events that occurred that led to that company to lose major of his what? Of his customer base. So it means that there is an indication of impairment that that company would have been impaired. The reason why you even acquired that company for the first place is because of that. But now they are not losing it. So it means something has gone wrong. So there is impairment. So that impairment will be calculated and subtracted from what the goodwill was as at when you acquired it. To now get the goodwill as at when you are what? Preparing the consolidated accounts. Do we get that? Now, it will interest you to know that our purchase consideration, time. It will interest you to know that the purchase consideration is of two types, or rather is attributable to two
We can't hear you, sir.
Please, if you can hear me, confirm if you can hear me, please.
Yes, sir. Yes, sir. I can hear you now.
All right. I'm sure others can hear me as well.
Yes, we can hear you, sir.
Yes,
Okay,
I can
so
hear you.
It's back, sir.
good.
Yes,
So
we can.
I said that it will interest us to know that the purchase consideration is from two people. I said the parent company and NCI, because I said earlier that the subsidiary is owned by who? By both the parent company and NCI. The only way the purchase consideration can come from the parent company is if the subsidiary is a fully owned subsidiary, meaning there's no NCI. But in real sense, you usually have both parent company and NCI. So back to this. Now, the purchase consideration is attributable to both the parent company and NCI. Now, it will now also interest you that the purchase consideration from the parent company is known as what? Cost of investment. While that of NCI is known as what? NCI value. NCI value. And don't forget, we said that goodwill should be measured at what? Fair value. What that means is that, please, sorry about the background noise. What that means is that all the components that we will make use of in calculating goodwill should also be at fair value.
Please, I can't hear you. Hello?
Even me.
Thank you. I thought I was the only one.
I think it's a general problem.
Please, let's just share this. They should help us share this video immediately because it's just been off and on.
Please, can you hear me now?
Yes.
Sorry about that. Network just keeps interrupting. So is my screen up now?
Yes.
Yes.
It's still on.
Okay. So, as I was saying, I said that, remember we said that upon initial measurement, goodwill should be measured at fair value. So what that means is that all other components that we make use of in calculating goodwill should also be at fair value. That's what it means. It should also be at fair value, meaning that both the purchase consideration and the net assets must be at fair value, which invariably means that the cost of investments of the parent company must be at fair value, and also the value of the NCI must also be at fair value. So let's have that at the back of our mind. Let's not forget that. Now, it also interests you to know that our cost of investment are five types. So we have 5 types of cost of investment. We have cash consideration. So this cost of investment is also known as what? Purchase consideration. So we have cash consideration. We have share consideration. All of this is in the material. We have deferred consideration. We have loan consideration or loan notes. Then we have contingent consideration. I'll follow you. So then we now have the method of valuing NCI. So that's for the parent company aspects. So therefore NCI, we have methods of valuing or measuring NCI. So there are two methods. We have the fair value method, which is otherwise known as the full goodwill method. Known as the full goodwill method. Then we also have the net asset method. Let me put it that way. Net in full, we call it proportionate share of identifiable net asset method. So, but let me just put it in short, net asset method, also known as what? Partial goodwill method. So then we cannot write the computation of goodwill in full by saying that goodwill comprises of the cost of investments plus the value of NCI. Don't forget everything is at fair value. Fair value. NCI value. At date of acquisition. So the two will give us purchase consideration. Then you will now subtract subsidiary net assets at date of acquisition to get our goodwill at acquisition. And don't forget that the net asset of subsidiary, carry down, coming, please. Don't forget that the net asset of subsidiary DOA will be gotten from this net asset of capital and reserve. So the final figure here, this is known as net asset. So this one as at the reporting date, as at the acquisition date, this DOA. DOC is reporting date, DOA is acquisition date. So this figure here is what you are taking as the net asset of subsidiary as at date of acquisition. Is that clear? Kayode, you have a question for me?
Okay, good afternoon, sir.
Yes, sir. Good afternoon, sir.
For exam purpose, the NCI on acquisition date, are we to use the parent company, as in the parent company policy, or which one are we to use for the NCI on date of acquisition?
Okay, so thank you for that question. Because of the time, by the time I'm explaining the measurement of NCI, I would have explained that. But as you bring up the question, so for the purpose of exam, to know the method to use, it is based on the work, on the group policy. So the group policy will determine whether the fair value method of NCI or the net asset method to value NCI. However, if the group policy is not given, and also the examiner does not clarify us on the method to use in the question, so there is a guide to know which method to use. The guide is that you make use of the fair value method. That's the first thing you're looking at. If the examiner is silent and there is nothing as relating to which method to use, what you should comes to mind is that the fair value method should be used, provided that one, The NCI at acquisition is what? Is given. So if they gave you the fair value of NCI as a DOA, if it's specifically given, then you know that the method they are using is what? The fair value method. The second method is if the fair value of the what? Of the subsidiary is given, you know that that's what you are using. Number two is if the market price per share of the subsidiary is given, then you know is what? Is the fair value method you are using. Then last is that if the goodwill attributable to NCI itself is given, then know that is the fair value method you are using. However, if any of this information is not available and the examiner is also silent, then automatically you should know that you are making use of what? Of the partial goodwill method, which is the what? Proportionate share of the identifiable net asset method. Is that clear, Kayode?
Yes, sir. Thank you.
Welcome. Distinguished ladies and gentlemen, is 1:04 already. I don't know, you have a class by 2. This is expected to be your break time. Sincerely, the revision of group account, because of those that are just joining, I don't know how possible it is to just cover everything. I don't know, because it's a whole lot. So I will advise for those that are coming from other levels apart from the skill level, those that have ANAN, those that has BSc in accounting from mutual understanding with ICAN, MCATs, so like that's other professional qualifications like that. What I would advise is that this material, go through it from beginning to the end, just read through it. Then I sent a question to the group. I don't know how that will help out because this material does not have where there's a prepared consolidated financial statement. So I don't know how that will help. It only gives us the breakdown. Yes, it only gives us the breakdown of what to include in each items. So that's what it gives. Kayode, you have a question?
Yeah, sorry, sir. Sorry for lastly, under we have positive and negative goodwill.
Yes.
So if we have negative goodwill, how do we make treatment for that? Please, sorry, just this last one.
Okay, okay, you should understand. When we have negative goodwill, this principle still applies. If you have negative goodwill, that negative goodwill in line with IFRS 3. Okay, let me quickly explain that since you bring it up. So please, hope I'm not taking anybody's time. Please, we do not usually exceed the time. So the goodwill we see here, like I said, is positive goodwill. And positive goodwill in line with IFRS 3 is an asset. They see it as an intangible asset. Intangible assets, or let me write it in full, intangible non-current assets. Intangible non-current asset. So this is assets. But in a case whereby you have a negative figure, the standard says that that is a what? Negative goodwill. Negative goodwill or gain on bargain purchase. So what that simply means is that, coming back to the illustration I gave earlier here, that the entity worth 200 and the entity worth 150 and you paid 200 to acquire them. So let's now assume that the entity worth 150. So let me know 150. Okay, let me use 150. and you paid 120 to acquire them, you know that you have a negative of what? 30. So you are saying, the standard is saying they want 150, but you are paying less amount. That's, as an investor now, you are paying less than the worth of a thing. To you, it is a gain. You would be happy that, no, I have bargained very well and I made a gain on my bargain. The seller say, no, don't rejoice yet. Don't rejoice yet that you make a gain on your bargain purchase. That the first thing you need to do is to assess the criteria, the necessary variables that you use in calculating the goodwill, such as the purchase consideration and the net asset of the subsidiary. That's what the standard says you should first do. So it means that in the process of carrying out a reassessment, a recalculations, a computation of all the variables used in calculating the goodwill, you may discover that an omission has been made, or an error, or you fail to recognize asset that should have been recognized. So the standard says when you do a reassessment of all this and you do necessary adjustments where necessary,
Please, I can't hear anything.
So some of us we still have class by 2. Let's end it. We'll continue next class.
Yes, let's enjoy our break because we just have 1 hour and this entire thing is till, I think, 10 o'clock. Today's class is ending by 10, so let's go for break.
please let me just use 1 minute to just round up. We are done. Let me just use 1 minute to round up, please. Sorry about the network issue. So let me just, so as I was saying, this is if you carry out the assessment and you discover you still have a negative. So the standard says that you have made a gain on your bargain. So that amount should be recognized as an income. You recognize the amount as an income and not as an asset. So it's an income. So Kayode, does that answer the question?
Yes, sir.
So that income will now be shared based on the method used. If it's fair value method you make use of, then you share it between the parent company and NCI. But if it is net asset method used, it is only the parent company that will take the income. So that amount you add it to what? To the parent company retained earnings. So that's that about that. All right, ladies and gentlemen, daddies and mommies, sorry for taking much of our time. So I advise those that are coming from other listening to, please go through this material. If possible, get the videos of last diet where there is revision on group accounts, so that it can be on the same page with us. So if you have any question, please send to the group. To meet again next time, the recorded link will be sent soon, immediately after the class. The material also will be sent soon. So thank you very much for your time.
Yes, sir. Please, the question you said you sent, did you send it to the WhatsApp group or is it on our app?
Yes, to the WhatsApp group.
On group. Okay.
Yes.
Thank you, sir.
All right. Thank you, everyone.
Thank you so much. We appreciate.
All right, sir.
Yes, sir.
Thank you. We really enjoyed the lecture.
Thank you so much, sir, for the compliments. Thank you.